Tonight, the market rocket ship continues, but for how much longer? The Strait of Hormuz is still blocked. And what about the summit with Trump and Xi that's now concluded? Is that a good thing for our portfolios, or is China going to give us trouble with Taiwan? And the earnings reports just continue to astound to the upside. All this confluence is just kind of crazy. We're going to talk about it all and make sense of it tonight. From Chicago, it's Thursday, May 14th. I'm Charles Brown, your portfolio manager, and this is CB3 Live. We're so glad you're with us tonight, and there's so much to talk about, as there is on every show, but it seems like more than ever now, especially with these very strong, what I'll say are conflicting news items in the market. Yes, the market rocket ship since the lows of 4 weeks ago. It seems like the market is just ignoring the fact that crude oil is back over $100 and it was $70 on February 27th when the market closed that day. Market doesn't seem to care about that. And so what is business? And that's something that we're going to live with for a while until this is straightened out. Now, the Republicans know if they don't get this fixed soon, they are in grave danger of losing the House, certainly, and possibly even the Senate, less likely. But they're just not making much progress with this situation in Iran. And Iran is just hoping to wait this out until the elections in November. Is usually considered high. 25 is really high. 31 is not crazy high because the VIX during 2008 got up to 70, but it didn't stay there. All right. But it would stay above the 20-30 range even for days. Let me come back on mic here and see if we've got a problem with our audio. So I'm not sure what's going on. I'm seeing my mic is on. We haven't had audio problems with this before, but tell me something. Somebody say something in the chat here. I think I see my mic. So this is kind of concerning. I have not seen this happen before, guys. It looks like we have an audio issue when I go to the slides, and I don't know why that is. All right, I'm going to go back to. Okay, are we better now? All right, guys, here we go. All right, I'm getting the feedback now from you guys in the chat. Thank you for that. Let me back up. I don't know how much farther back I need to go. Did you see? Did you see anything? Let me toggle back here. First of all, can everybody hear me? I see the mic is on. For some reason, it got switched off. So let's just briefly go back here. This was the market scorecard. And I know we're on a 20-second delay. Yes, working now. Okay, great. So don't know what happened. Never had that automatic mute kick in, but at any rate, there it is. So market scorecard, I covered this. Material sector is what's really strong right now. The communication service is lagging, okay? The VIX is compressed, so it was up at a high of 31 and dropped all the way to 17, just a little bit off of that right now. And it's surprising. Now I'm going to switch to live and make sure that when I go back, the audio is still there. But what happens when the VIX gets high is, of course, people panic. They start selling, raises the cost of SPX and SPY options, and it just puts panic into everybody until something happens to drive that down. So let me go back to slides now and make sure that that's working. All right, my mic is still on. Okay, guys, sorry about this. Never had this happen in 7 years, but for some reason, the mic just stopped working there. So moving forward, first quarter 2006 earnings. All right, final scorecard, really good, 83% beat rate. The long-term average is 67. Although if you look down in the copy here, you'll see quarter 5 of 2025 was 73%. That's, since we've been doing this show, 73 is what we're calling the average beat rate for earnings in a given quarter. So last quarter, which is closed now at 83, is really strong. All right, really, really strong. Now quarter 2, which we're in right now, currently at an 88% beat rate. Technology, 98%. Healthcare, 91%. Staples, 88. I mean, you look at, utilities at 75 and go, well, the norm is about 73. So they're at 75. It's just kind of astounding, which is why even with this war situation, even with crude oil at $100 a barrel, you're still seeing the market strong and at or very near lifetime highs. Because what drives the market? All right. Do these geopolitical things drive the market? For the short term, they can. But the reality is that over the long run, it's earnings and Fed policy, earnings and Federal Reserve policy. And both of those are fairly favorable. The Fed, not so much, but the earnings are just knocking it out of the park. And this is really, really good for America. And that's why so many dollars are coming into this system of, I'm going to call it just freedom investing. All right. We are the largest, freest country in the world. And that's why people are attracted to it. And the money pours in, the investment goes in these companies, they crank out more widgets or whatever they do, and it just makes earnings grow up and it makes our portfolios go higher. It's just a great match. So, as I said earlier, so the downside here is we have flaky policy. And I'm sorry, you guys know that I'm pretty conservative, but I'm not really happy at all with how this has gone with President Trump and the Iranian situation. The Strait of Hormuz, I don't know why they're still having to ask them to open it. We have 20 times the military might that they do. And this consternation, I think pretty much, again, the market participants, and especially the options market, because those are the people who really have the sentiment in hand and understanding where the direction of the market is going to go. They're all saying, look, you can say whatever you want. This is not going to shut down the world stock markets. And that's why, again, the market is so strong here. So this is the highlight that I see from the Trump-Xi summit, day one in Beijing. Day one, obviously they finished day two. They're 12 and a half hours ahead of us. So that's why. 2.5 hour, 2.25 hour meeting, pretty strong. Both sides cite a balanced, positive outcome. Okay, that's just marketing. Preserve the October 2025 truce. Okay, the tariff suspension for rare earth flow. That's a real big deal with President Trump. And then they'd like to expand the U.S. market access and an AI dialogue. So the issue with the dialogue on AI is that there is nothing that China will stop at, in my opinion, to pooch AI technology from us. And they even shut down Manus, M-A-N-U-S, which is a really strong AI agent out there. And they made it unavailable to companies like Meta and others because their intellectual property they thought was being stolen by us. Well, actually, we have enough right here. Thank you very much with Anthropic and OpenAI. But nonetheless, the Chinese get concerned about it. The biggest sticking point, and no surprise on this, was that Taiwan was the most important issue. Why? Because Xi doesn't want the U.S. meddling in what they call their business. But there's actually a $14 billion U.S. arms package on the table that Trump hasn't signed yet. It's been approved in Congress, but Trump has not signed it yet. So what's next here? We're waiting to see if Xi will say, you know what, we'll just buy some crude oil from you, like millions and millions of barrels from you. Hasn't done so yet, but I think that that's a possibility. And President Trump floated the idea of Xi coming to the White House in September. I can't recall any time in my lifetime when there have been two high-level meetings with the Chinese in 1 year. And this year there definitely could be two and possibly even three around the holiday season to make progress here. And that signals to the world that even though everyone knows we are arch enemies, we still can negotiate in reasonably good faith with our enemies for the good of our nations, of course, and for the world. Because when the world sees that the US and China are relatively at peace, it calms the boiling point of the entire geopolitical climate. And that definitely applies to Russia, definitely applies to Iran, and to some extent even applies to North Korea. Okay? So the Iran situation, it's a recalibration, not really relaxing anything here. The VIX collapsed, which maybe makes people think everything's going to be fine, but crude is still at $100. S&P had a phenomenal April, which was just an overreaction. Frankly, I think that is going to come back into some kind of correction. I mean, we just don't have 10.5% months very often, especially when very little has changed. Although I have said, of course, that the earnings reports are certainly strong, but there's just enough out there event-wise that still needs to be dealt with, like the fact that the Strait of Hormuz only has about 5 to 7%. I've seen both numbers, 5 and 7, but it's single digits of traffic prior to the levels that it was experiencing before February 28th when the attacks started on Iran. Crude oil at 100 to 101. 70 plus vessels have been turned around. I think that's going to be higher over the next few weeks. For sure, it's going to be hundreds of vessels turned around. We still get reports that there be small submarines going out there from Iran and putting mines out there. But if that happens, they're just going to be obliterated by our arsenals. The problem is that there's just a different culture in Iran. All right, the situation there is those mullahs will kill their own people. They'll let their own people suffer. As long as they stay in power, they don't care. And when you have a situation like that where you don't care about your own people, we probably care more about the Iranian people than their own leaders do. And that's just a real difficult situation to try to negotiate a peaceful end to this, okay? So the risk has not gone away. We recalibrated it. We're still hedged in our portfolios because we're not going to have a situation like 2008. As I've mentioned on this program many times, most of our clients are at retirement age. I don't have 30-year-olds coming to our firm, all right, or even 40-year-olds, all right? We'd welcome them, but the reality is that people don't want to see their portfolios have a 35 to 45% drop like we did in 2000, 2008, for a short time during COVID in 2020, and that's why we use this hedging. The downside of that is when we have these rocket ship months like April, the portfolios can't keep up because there is a cost to that hedging, but it's there to protect to the downside. All right. Crude oil, as I've been mentioning, we're just nowhere near where we were before the war started. February 28th is when it started. So the February 27th Friday price of crude oil was around $70. It's, 40% higher than that. And the market doesn't seem to care. So that to me is resilience. And I think that's a positive for us going forward. So there he is, Kevin Warsh, the new Fed chairman. No more pictures of Jay Powell, which I've had here on the screen for the entire time I've been doing CB3 Live. But Jay is gone. He's actually still on the Federal Reserve Board, but he will not be speaking much in public at all. The Fed is boxed in. They've got a Fed funds rate at 3.75. They've got this FOMC meeting coming up in June. That'll be the first one where Kevin Warsh is the chairman, and they're going to hold. They're not going to be able to cut anything. Goldman Sachs is predicting now the only cut this year will be in December. Many people out there, and I'm in this camp, I don't think there's going to be a cut at all this year. And that's because this inflation, I mean, the Fed's target is 2%. 2%, and we're at 3.75. I mean, how do we get that down to 2% or 2.5% so that the Fed can cut a quarter in December? Really hard with crude oil at $100. Again, the remarkable part is that with this inflation, with the Strait of Hormuz, with the Xi and Trump thing really not going very far in having any definitive progress, the Ukraine war is still very much active. The market doesn't care. Folks, this is a characteristic of a bull market, a raging secular bull market. It started on April 10th, 2013, and I think it continues above 2030, 2032, somewhere in there. And we're a ways from that. So we're riding on that. All right. So the new chair, same box. He's still got to deal with Jay Powell and what happened there. All right, the confirmation vote, 54-45, only one vote from the Democrats. So this is the closest vote in, I don't know, 50 years. It just shows you how partisan it is in Washington. It's really bad. And, I'm just sorry for all of us as Americans that the Republicans and Democrats, as you know, I'm a registered independent. So whichever side of the aisle you're on, you have to be frustrated with Washington being such a mess right now. So again, 30 days from now, he has his first meeting. He's inheriting a 3.75 Fed funds rate, 3.8% CPI, core sticky, not dropping. Sticky means it's just staying there, not dropping. And of course, we have this oil shock, which is still there. There's no honeymoon for him. And former Fed Chairman Jay Powell stays on, so he will have a vote until 2028. This vote happened under Jay Powell, his last time to be the Fed chairman for one of these Fed meetings. An 8-4 split. This is the first time in 34 years. I'm laughing because 34 years, that's like half a lifetime for me. Normally, the Fed governors are all in sync on policy because they meet, they see the data, they're all very educated people, men and women, and they come to similar outcomes, but that is just not the case right now. So even the Fed, just like the Supreme Court, just like the American people, is very much divided. I'm not going to say it's blue and red on the Fed. Sorry for the bad joke or pun. But the reality is that it's just unusual to see this kind of split. So this means a hold going forward until at least December. All right. So for GI, which is tonight's featured portfolio, we're very much on track with our fixed income sleeve, short-term fixed income. And again, I don't want to get ahead of myself here, but we'll see how that plays out and what we're doing to generate yield for you, but not taking the long-term risk that we had in the bonds in 2022. So I'm going to do the employment situation. I'm going to mute my mic just for a second to get a sip of water. Hope you can hear everything. I don't know if the quality of the mic was not working or just the volume, but you guys can let me know. Thanks for letting me know in the chat. I'll be back with you in just a few seconds. All right. All right, let's see if we still got our mic here when we go back to the show. All right, here we go. So wages, non-farm payroll. So we do the show on the second whenever we can. I don't know if we're going to be able to do that in July. I'll tell you more about that next month. But we do the second Thursday of the month because the first Friday of the month is when non-farm payrolls comes out. Non-farm payrolls is the single most important data. There's a bunch of data in this. Data is plural of datum. It's not just non-farms payroll, which is datum, but like 6 or 7 different components. We'll get through some of that tonight, but this is the biggest news item of any given month. All right. And it just sets the tone. The employment situation in America is highly important because when people are working, they're spending money. When they're spending money, companies make more widgets, blah, 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 blah. You get that, right? So we're seeing average hourly earnings up 3.6%. All right. That sounds good. The problem is that CPI is 3.3. So that means that the real wage growth, whenever you see that word real, that means that that's the net. Okay. Because whatever you make, you have to deduct inflation from that because, you have to overcome inflation at least, right? So 3.6% average hourly earnings, inflation at 3.3, which means average hourly earnings up 0.3%. That's not much. But they are at least getting real purchasing power for the first time since 2024. So that means that purchasing power has not even been equaling inflation since 2024. And as we all know, when the current administration came into office, inflation was pretty high. And it has gone down some, but not nearly what needs to be done to satisfy the American people.
No volume.
All right, I'm still seeing my microphone on and high here, I guess. Let me know if you don't hear me, but I don't know why we're having microphone problems tonight, folks. But anyway, it looks like it's working now. So unemployment rate 4.3% unchanged. All right, that's high. We don't want that. And what's even worse than that is the U6 rate. So U6 is the people that are underemployed or unemployed. All right, so underemployed is more of a concern, obviously, but underemployed also means that people want to work more and they can't get the rate, they can't get the hours that they want. All right, and that unemployment rate is up 8.2%. And that's way higher than the 4.3%. So it's a surge in part-time. And I think that that is probably because of AI. Because companies are literally, I hear situations, literally 2 people in my life that have said, yeah, they're starting to record all my keystrokes now. Everything I do. And then they're sending it to Claude or whatever to analyze my keystrokes, programming that and saying, well, I can, if this is what they do every day, every week, every month, I can replace that with a program and then I don't need them, or I don't need them for as many hours. Maybe it's just going to be part-time. So that's what we're seeing. And that's why this part-time U6 rate, as I call it, as opposed to U3, has been rising. So this is what's happening. All right. So where are the jobs coming from? Well, I like seeing them in healthcare, transportation, retail, social assistance. Okay. Information, I don't like seeing that drop there for sure. Federal government, I wish that minus 9K was minus 90K. But that's me. Manufacturing, don't like to see that for sure. We're still seeing some offshoring happening. So companies leaving here, going elsewhere. But Trump, of course, is doing everything he can to get companies to reshore. Reshore is the opposite of offshoring. Reshoring is saying to Apple and Nvidia and other mega companies, bring your manufacturing back here. And Apple is doing more manufacturing here just in the last year and a half in the Texas area, but it takes a while to totally rebuild factories. I don't think that's going to happen in Trump's term, but if the situation with tariffs and tax incentives makes it more profitable for American companies to come back and manufacture in the US, it's going to be dire for these countries overseas that have been used to having American companies building there. But that's their problem. Our situation is we want a stable America. We want an affluent America. We want every single American to have an opportunity to succeed and maybe become the next Elon Musk or Sam Altman or whoever you want to fill in the blank, right? So, but that's where the jobs are coming from. The revisions, what happens when they go back And every first Friday they announce what the April earnings were, or pardon me, what the April unemployment rate was. Well, they have to go back and revise February and March, and we actually lost more than we thought in February, which was, not particularly a strong month. And then March, much higher. So at any rate, that's where the jobs came from. I have sound on my desktop, but no audio on my phone. Doc, I don't know. This is just a strange night tonight. But I'm glad you got it on your desktop. Anybody else want to talk in the chat here? Because I am seeing my mic on full, but if you're not hearing it, maybe I'll just pause the show and restart it or something, because I don't want you to lose what I'm saying, guys. On the inflation front, double hot print. So I talk about this every month. We have two key data points every month, and they both happened in the same week. This week, they usually always do, the week of my show. The CPI, which is Consumer Price Index, and the PPI, which is the Producer Price Index, all right? Guess which one is higher? You can see, all right? So next, Charles Brown IV. I see. Thanks, Leo. Well, you can hear me then, right? I guess you can, or at least I see you typing there. So just crazy here, guys, to see such a disparity. So here's the situation. PPI is a much bigger shocker. You can see that over there. All right, largest single month gain since March of 2022. And as you're going to see on the next slide, what happens is PPI happens first to businesses, but then they pass on those prices to consumer. So I'm watching PPI almost more than I am Consumer Price Index, because that could be the inflation against which we need to hedge in our portfolios for future months. You see what I mean? Now, I've never really talked about this. Okay. Sound is fine on the desktop, but not on the phone. Do not know what happened there, guys, but I'm glad you guys are diligent and you have both a desktop and a phone nearby. This is an important slide. Again, I've never really talked about how PPI front runs CPI. It would make sense based on what I just said, that CPI, is going to be reflecting of what consumers are paying. Well, they're going to be paying more based on what they're having to pay for goods and services, whether it's discretionary or staples, right? All right, they're going to have to pay more, and the PPI leads the companies to change their pricing structure that consumers must pay. So we're watching this to give us a clue on how our hedging strategies need to apply in all of our programs, because as inflation rises, markets tend to become more volatile. Interest rates do not drop, or interest rates even get an interest rate hike, which of course, as interest rates hike, it makes fixed income investments like CDs, but certainly bonds and T-bills raise in their return. And if you can get a high enough return in a fixed income instrument, I mean, let's face it, folks, if you could get 20% in a CD, even 14% in a CD, you probably wouldn't risk your money in the market, right? Or very little of it you would. Well, if you can find that 14% T-bill or CD, you let me know. But this is the balancing act that we talk about every single month on this program. And that's what we have to do on your behalf on our show. That's what we're talking about here. And of course, that translates into how we actually manage your portfolios. So this pipeline wedge, this actually has nothing to do with pipeline as in crude oil, all right? So look on the right side, what's in the pipeline. So we have a 6% PPI April year over year. This is what businesses pay today and what consumers pay tomorrow. All right, 6 straight months of acceleration. Now this wedge is the difference between the 3.8 Consumer Price Index and the 6.0 Producer Price Index. All right, producers paying more than consumers see. So somewhere in here, this gap is going to close. It's going to either close by CPI rising or PPI falling. Don't count on it being PPI falling. That's just not going to happen. All right, because they pretty much move simultaneously. But this gap is what is causing this inflation angst. Again, it's not affecting the market, but that is because the earnings reports are so strong, and that's because there is still so much consumer demand for widgets, whatever you're buying out there, staples, discretionary, etc. But at some point when that tapers off, if the pressure from PPI, Producer Price Index, continues to be that much higher than the Consumer Price Index, it's going to eventually, colloquialism here, drag CPI through the mud, which means that people will stop buying. And if they stop buying, companies start laying off, et cetera. And you can see where that downward spiral will go. At this point, it is literally impossible to have a recession with the market this high and earnings this strong and unemployment really in a really good place here. So, okay, so energy is the reason. It's not the total story, but energy is the reason that this inflation is so rampant. The biggest single component of all the goods and services that we buy is crude oil. I mean, you could say it's a house, okay, but the consumable item, it's not gasoline, it's crude oil, which gasoline is derived from, and heating oil comes from that, and liquid natural gas comes from that, etc. But this is crucial, and we are the biggest exporter in the world of crude oil, but much of that crude oil is going overseas. It's too complicated for this particular section, but just know that if you've got crude oil at $70 on Feb 27, and when the market opens on March 2nd, crude is in the 90 range and then heads up to 103, that's going to affect things. That's not a 5 or 10% bump. That's a 35, 40% bump. Okay. Now, it's amazing to me, really, that the consumer spending is almost inelastic. We just continue to spend. But the worrying part, and this is why we hedge, this is why we are watching every single day in the market and what we need to do to maximize your risk-adjusted return. And by risk-adjusted, I mean, obviously, we could just put everything in NVIDIA, which is like just talk about its own rocket ship. And it is our single largest position. For those of you that have a mixture of CG, DS, and GI, it's our biggest holding. But you can't put everything in there. You just can't, because these rocket ship kind of moves tend to have a crash at some point. If you don't believe me, go back and look at a silver chart. Do you remember back in January when we were talking about silver over 100, and where is it today? All right, way lower than that. So stocks do the same thing. All right. So here's the Fed math. The 2 GI response, because we're going to move into now talking about GI. 0 cuts priced in today. All right. Triple pause through year end. Goldman Sachs says there that we're going to have 1 rate cut, but I don't think it's going to happen. Rate cut odds 39%. I think that's high. I think it's about 20%. We still have our hedge in place in GI, of course, as we've been talking about, and the 22.5% floating rate short credit. So we do not have any long-term 30-year bonds in the fixed income portion of GI. We really only talk about this when we're doing a GI review, which is the second month of every quarter. We just started this, so if you're wondering, gee, I missed that in February. Nope, it just started last quarter, actually, but certainly CG was last month and DS will be next month. So, all right, I'm going to take another voice break here. For some reason, I'm kind of hoarse, but we will get into covering GI. I want to just look through the notes here. Most of what I see is the comments on the audio. And again, I'm really, really sorry. I do not know how this happened. Did I miss anything else? Hey, Keith, how are you, sir? Audio cut off. Yeah, I'm back. Okay. The mystery button on my system here. Again, 7.5 years I've been doing this, never had this little thing cut out. But you guys are patient and I appreciate that. Okay, sound is fine. Audio on. Restarted my iPhone and now I have sound on it. Well, I'm sorry you had to restart your phone, Doc. Here I am crashing people's phones out there. Oh my gosh. All right. PPI is real. We see it in our manufacturing process. Yeah, so that's Leo. Leo's been a guest on this show and he would know. I'm not going to mention the company for whom he works. He can do it in the chat if he wants to, but they definitely have supply chain issues. They had them big time during COVID. And so he's very sensitive to this PPI, and we have to be as your portfolio manager, because it will eventually, sorry for a strong word, metastasize into CPI. Okay, so here we are, 2GI. Many of you, not all of you, but many of you have investments in all three of our programs. CG, which we review the first month of the quarter, GI now the second month, and then June, which will be the third month of the second quarter. We're going to cover DS and MP, which is our mini portfolio. I'll explain more about that next month. So discipline doesn't look like much until you see what discipline prevented. And discipline prevented uh, this portfolio from turning down. In fact, this portfolio was beating the S&P for the first 3 months of the year until April just took off like a rocket ship. And this program will never keep up with a rocket ship because it has a large component of fixed income. So we have 17 holdings, 0 sell signals, made 4 trades, and we did roll the hedge. So here's how we're positioned for the rocket ship portion of the market. 40% of the program is in SPY. SPY is the ETF, that is the S&P 500, and then 12 satellites. We're going to go into each one of these here, every signal, every trade. We increased our position in CAT. We'll talk about that. And then the Fed basically is saying, they're boxed in, they're not going to cut rates. Okay, well, we're still going to get yield from these 4 ETFs, HYG, BKLN, SCYB, and SGov, okay? Paying pretty nice yields on this with no duration extension into the curve. That's a fancy way of saying, by the way, that was written by Claude. Sometimes I correct what Claude says. It's like, dude, you're not talking to another machine, you're talking to people. All right, but we're not going far out on the yield curve. That's where it's very, volatile. It's kind of like riding a roller coaster, and it's not quite as dramatic to ride a roller coaster if you're in the front than it is the very last car. It's definitely a very different experience, okay? And that's what it's like with fixed income. The shorter duration doesn't yield as much, but we have carefully pruned those for you so you can get the most risk possible. And the tail risk with the options, of course, it remains there until this Iran situation gets solved. It's a convex payoff. That means it pays off like it did in March after the invasion, with these options just kicking in and keeping the portfolios from dropping. At one point, the NASDAQ was down 20%. We were less than half that. All right, so that's what the convex payoff means. So let's look at the architecture. There's the core SPY 40%, the satellites, those are individual stocks, and then the fixed income at 22.5%. The yellow is the options hedging at 2%, and then 1% cash. That is, if you are in GI, this is the balance of your portfolio and how it works. We're on version 179. Didn't used to publish these, but people sometimes want to know, and you will see these if you log into our website and look at the fact sheets for May. We're going forward. I need to explain this. We're now using forward-looking fact sheets. So even though it's got April data, I'm calling it the May fact sheet. We publish as close to the first of the month as we can. If it falls on a Friday and then you got Saturday, Sunday, sometimes it doesn't get out till the 4th or the 5th, but very early in the month is when we publish the fact sheet. And it will have a version number so you know how many times we've traded. Normally it's once a month. But there are other times that we have to trade more often than that. So we, as I mentioned earlier, we bumped up our weight in CAT. Just been a phenomenal holding, 107% on this. You guys have been with me on this. That's a double. BK did so well that we had to actually sell some of it to get it back to its target. We added to the target for GE and RTX, which is the defense sector, and then the hedge we reduced. Basically, we had too much hedge. We were really well positioned in March, but just like we were in April of last year, Trump, with the tariffs, Trump can make the market go down 15% in 2 days if he just keeps talking, and then he changes his mind and the market rockets back the other way. It is mercuric. It is very, very frustrating. And that's what happened in April. We just could not capture as much upside as the market did because the options hedges, which had protected us to the downside in March, became a drag on the portfolio. So we've adjusted that blend. We've gone from 3% to 2%. Doesn't sound like much, but it's actually substantial cut in the weighting of the portfolio. So 17 signals, all on very strong buys. It's the third month of no middle, like hold signals here. These are all strong buy signals. We have a 3 confirmation framework, these signals here. And I do just want to say, a couple of next slides here are going to be kind of technical, but we have viewers that are really technical. They want to know, how is this being done? I look on this chart and I see this moving average or this RSI. So these next charts are for you. All right. Those of you that just want to know that we're working with a very solid strategy, a very well thought out strategy, a very well calibrated strategy, these slides are for you, but mostly just to build confidence that we know what we're doing, that we're looking out for your best interests here. So this is a chart of the S&P 500. You can see that big red arrow. This is back to April of last year when we had that huge move down, which looked like it was going to be another 2008. We had to take stops back then because we did not have the options strategies in place. We couldn't do it at Interactive Brokers. That's why we moved to Schwab. Everybody knows that now. All the clients are at Schwab. Had that red bar that happened there just in February or in early March, and so that's we protected against that with the downside in the options. So we have 3 different signals that we use. And these signals are just 3 ways of interpreting the market. Let me go back here and you can see the 3 lines on the top there, green, purple, and blue. And on the bottom, the top signals are the buy signals. So once we get into something, we stay in it until it closes below one of those lines on the bottom. It's a mechanical signal, but we have calibrated this over years of study. What happened in April, see the big fat red arrow there, is it pierced that and put us on a stop. But then after Trump said what he did, it recovered and actually closed above that. If that same thing were to happen today, we would never have sold anything because we have the options in place that protect us in case that doesn't come back up. There will be a time. And I had 2 clients this month say to me, look, it always recovers. Why are we doing this? And can I trade without the options? And the answer is you can trade without the options. We don't have any clients that are so far. Everybody's approved of the process, but you can. But when it goes down, there will be a time when the crying wolf, so to speak, there really is a wolf there, or maybe 5 or 6 wolves there, like 2000, 2008, and many other years, certainly 2020 for a brief time. All right. And we just don't want you having to have a 5-year, I'm going to go back to camera. You don't want you having a 5-year recovery when it's something that we could have prevented by having this options hedging. And that's why we do it. So that's our system. And again, no discretion, no overrides. We take the signals, the signal owns the seat. So where is GI tilted versus the balanced benchmark, which is AOR? We have a little more in industrials, a little less in financials. We trimmed that this month, just seeing some earnings reports in the financial sector that were not really strong. International emerging market, 2% higher than AOR has, and then healthcare actually less, okay? And that hasn't helped us this month. But most of the last 3 months, it has been good. We've been underweight that. Technology we're just using because there's so much technology built into SPY. We don't need to have that in any of our satellites. We have fixed income of 22%, which of course AOR has 40%. So we actually have less of that hedge because we have the options. We don't need that much. And the hedge, we have, as I say, 2%, whereas the benchmark has nothing. Obviously, we adjust this over time, and we do that always trying to give you the highest risk-adjusted returns. That is the strategy every single month. So let's go through the holdings. Boeing, we're up 4.6% since we bought it, okay? So the gain on the cost of what we paid for, it's 4.6%. Really strong aerospace recovery. Boeing, I think, is announcing that they had a down day today, but they have some new contracts from China, and I think that's probably because Trump went over there. This will be more revealing over the next few weeks. Watch my tweets because I will cover this in my tweets, which are every day and sometimes more than every day if something really newsworthy comes out. But we like Boeing a lot. BAP, this is a Peruvian credit corporation. Actually seems a little aggressive for GI, but it's just worked well. Just super strong, almost 35% return. Financial services, we like this. We didn't have to rebalance it. It's just really strong holding. Bank of New York Mellon, also really strong here, 31.2% since we've owned it. So each of these is going to be slightly different because we didn't buy them all at the same time, but this is since we've owned it. Okay. So the drift, very small here. They're a custodial trust company. In fact, they hold assets. They kind of compete with Charles Schwab and LPL and Raymond James and other big, even Goldman Sachs, but a huge holding company. And again, we like this. We like their dividend. Caterpillar, just phenomenal. 113, almost 114%. I didn't even count today, and they were up today, so it's probably 115% return. So we bumped them up from 3 to 4%. We think there is room to run in this stock. Now, if it doesn't happen, we will drop that back to a 3% target, but this is just really strong. The demand for their products is international. US company, really, really strong performance, great thesis, industrial conviction. EEM, this is the emerging markets that I talked about just a few minutes ago. Just really strong here, 14.5%. Only own this for 2 months. So you can do the annual return on that. All right. It's a strong thesis. All right. We added it in March, restructured it to get an international diversification as the dollar continues to weaken. And we did the same thing here. Now, this is an individual country, but look at this, 11% again in about 2 months. Really strong return. The largest country in Eastern Europe as far as per capita income. We actually have one of our clients that suggested this to me, and I took a look at it and added it. And yes, I am not so proud to say that I have all the great ideas. I have EEM and EFA, which are the developed countries in Europe, but I hadn't thought of just adding a single Eastern European country as opposed to France or Italy, Germany. Obviously, we've invested in before, but there's just so much going on in Poland, sort of at the crossroads there between Russia and Germany. Built up their defense. There's just a lot of good things going on in Poland. So we like this holding a lot. Nice return, pretty small weight at 2.5, but we could increase it. If other assets don't continue to grow, we'll grab it from them. GE Aerospace, underwhelmed by this, but it's a great, great space here. We added a little bit more to this. The target weight was 3. We added to 3.5. Only about a 5% return this year. But again, that's not bad if you figure that the annualized, is like 18% on that. But then you compare it to CAT and it just hardly compares. But we like this space. Again, it's diversification. Johnson & Johnson, great return, almost 23%. It's the healthcare anchor really in this portfolio. Dividend is great. Defensive ballast during equity drawdowns, meaning when some of the other holdings like the financials, like even Caterpillar, which is pretty volatile, Johnson & Johnson just keeps hanging in there and cranking out dividends, and in this case, capital gains as well. JPM is one of our biggest disappointments, all right? They're the money center bank, just huge, huge bank. Why they're being sold off, I don't know if it has anything to do with credit card revenue. Obviously, MasterCard and Visa with their policies saying, yeah, you're going to be paying this surcharge no matter whether you like it or not. It's going to hurt them. I don't know how much that's going to affect JPM, but in general, it's certainly a stronghold. We did reduce our position in this by 0.5%. Rockwell International, just a rock star. Sorry for the terrible pun. All right. 25% return on this. We've had it for about 6 months, I think. So just love this. It's automation. Probably wouldn't think of it as a typical GI holding, but it's really performing well, and we like it a lot. RTX, this has been the only loser that we've had, and it just seems kind of strange because it's defense, right? It's a strong conviction that I have on this. We bought a little bit more, actually, from a 2% position up to 2.5%. The Iran-Hormuz resolution removed the geopolitical premium that had elevated this defense name. So you could say, well, okay, why didn't you just drop it if that's gone? Because the risk is not gone. All right. If this really goes bad and the U.S. starts, major bombing, and brings in bigger missiles, then, this is going to be a real good play for RTX. So we like the stock, still on a buy, and we're holding it. This is SPY. This is 40% of the way to the portfolio. We changed this methodology on February 1st because we want to be able to capture technology in this program without having to actually own technology stocks, because it gives us room to have other high-paying dividend stocks. Why? Because the high-flying NVIDIAs of the world don't pay big dividends. Apple does, but they're not really a high-flying technology stock. They might want to think they are, but they're not. Oh, Palantir, no, you're not going to get dividends to speak of from any of these high-tech companies. So we're getting our dividends from SPY. And then Truist Financial Corp, modest return, again, like the other JP Morgan. It's definitely on a strong buy in a strong sector, but just hasn't pulled out of their, I guess, holding pattern here, just like JPM. So the fixed income sleeve, this is where we get 22.5% of the book. This is where, for those of you that are getting monthly payments, we're pulling it from GI. If you have a GI account and if you're in retirement and you're pulling money, you more than likely want to have a GI account, because we can get those regular funds from these fixed income sleeves, and then we rebalance going into the next month, and we start all over again as you take your monthly income. But these credit spreads remain well behaved, almost 20% credit sensitive, paying current coupons. And SGov, which is the government T-bill section here, is anchoring the liquidity. Basically 0% year to date. You can see less than 1% move in any of these, but what they do is crank out that yield. All right, 6%, 7%, 7%, 2.5%. Okay, the options hedge, we rolled yesterday from June to September. We reduced the delta risk from 20 and 10 to 15 and 5, and we reduced the size from 3 to 2%. What does this mean? It means we have less of a hedge. And you could say, well, gosh, now if we go down 30%, we're going to be hedged less. That's true, but that doesn't mean that I just stay at that level. Normally, markets don't go down 30% in 2 weeks, although that happened during COVID. All right, but we were lagging in April because we were hedged for a war, which was really working well for us in March. It did not work so well for us in April. So like any decent portfolio manager, we look at the data on the screen, we analyze it, we go into your portfolios and we make changes. And we're, again, always trying to give you the highest risk-adjusted returns possible. So here is that post-rebalance allocation: 40% core, 34.5% satellites. We have 12 names that are all on a strong buy. Those ETFs in the fixed income area are 22.5%. They are carrying the income for this portfolio. The hedge down to 2%. The delta got reduced from 20 to 15, and 1% in the money market. That 1% money market will pretty much always be there. Those of you that know what nitrogen is, used to be called Riskalyze. That target for this program is 60 to 70, and it's right now at 66. So we're right on track. This program, as I mentioned earlier, was beating the S&P 500 until April. So the first 3 months of the year, it was in positive numbers when the S&P was negative. So those of you that want to have a place to park money, to have slow growth rate, but steady as it can be in a stock market program, and have a place from which to draw income, GI is where you need to be. All right. Now, last month, I went into this income section, and people seem to really like this. So I'm doing a part 2 here. And what people said, I got 3 or 4 comments here. And by the way, you're going to get another survey. Where am I here? You're going to get another survey to fill out, and I hope that you'll do it. If you see a segment in here you really like and you want to see more of it, let me know. That's what happened last month, and that's why we're doing 3 more slides on this retirement income. All right. So sequence of returns. What does this mean? It means if you start your retirement in year 1 and it's a bad year, your portfolio could be completely depleted by year 24. And yet, if you have a downturn in year 10, that same 20% still means you've got 1.4 million. Now this is on a $1 million portfolio. Look at the above there. It says 1 million portfolio, 40,000 a year withdrawals, same 30 return average. Okay. So the takeaway from this is, well, Just make sure you retire in a year when the S&P is in a raging bull market. Yeah, sure. Everybody would love to do that, right? We have clients that retired in 2008. All right. And even 2009, which is a fairly strong year, we had clients that retired in COVID year. Did they fret? They did not. All right. And why is that? And I'm going to show you why now, because this is the strategy so that you do not have to risk being beaten up by the sequence of returns. The three bucket framework. And I want to watch questions here in case anything's coming up. How do you formulate the composition of each investment bucket? And here is your answer. Okay. So three buckets here. Now, this is not for people that are still working. It's not for people that are, have other forms of income, maybe apart from us, because we have some clients that are very, very wealthy and they use us for some of their investments and not others. So we do their growth stuff because that's kind of our specialty. But I want to show you here how we handle the retirement income buckets. Okay. So bucket number one, this is 10% of your money. So on $1 million, 100 grand would be here. 10% income now. This would be an SGov, money market, T-bills, paid current living expenses, and you refill this annually from bucket two. So 30% on $1 million portfolio, that's 300 grand, is going to be in bonds and credit. And even though I didn't put it on the screen, for myself, I would have a Johnson & Johnson, a Procter & Gamble, Unilever. There are other stocks, and I don't want to mention too many because they may not be in favor at the time, but having a few stocks, even in this second bucket, is not going to be detrimental. But mostly it's to provide stability so that at the end of the year, when you have exhausted the funds in your bucket one, you replenish that. And on the next screen, you're going to see how this works on the map. All right. And the third bucket is about 60% in equities. All right, SPY, the satellites, long-term horizon, refill the bucket two with this every 2 to 3 years. And of course, that depends on how the market's doing. If you have back-to-back really strong years, like we had in 24 and 25, you could move some of that over and actually have a little bit more money in bucket two. So if bucket two creeps up to 35 and your equities, drops to 55, not the end of the world. All right. So why this defeats a sequence of return? You want to defeat that sequence of return unless you can figure out, like I said in the last slide, how to always retire, every person on the planet retire in a year if it's going to be a strong bull market, and not have any terrible bear markets for 10 years, all right? All right, the sequence of returns matters. So how does a bad market never force a sale? It's this bucket three, bucket one. Let me give you an example here. Year one of your retirement is a good year. That's great. So what are you going to do? You're going to trim your equity gains. That's bucket three. You're going to refill your bonds into bucket two, and you're going to top off your cash in bucket one from the bonds in bucket two. Let's go back and look at that. So we're going to take money from our good year in equities. We're going to put it into bucket two. We've depleted bucket one. That happens every year. All right. And then we're going to take money from bucket two, which has been replenished from bucket three, and put that in bucket one. And now we have another year of life to live. And the second year of your retirement, 8%, not as good, but it's still positive. So we're going to do the same exact thing. We're going to continue the refill. All the buckets are full. Oh dear, here we are in year three, a bad year. 22% is more than a bad year. That's a really bad year. It's not a catastrophic year like 2008, down 58% at one point in the year, but it's bad. Do not touch B3, all right? Do not touch bucket three. Bonds refill cash. That's the end of it. All right. There's no bucket three to bucket two in a down year. It just stays there. Why? Because you've got ample reserves in bucket two. Now, let me just make sure you heard me. You're 40 or 45, even 50, and you're saying, I don't want that. I want to be growing. I'm going to work for 15 more years. Okay, don't use these buckets. This is for our customers, our clients that are either close to retiring or wondering how this is going to work. And there are some on this call, I know, and I'm telling you exactly how it's going to work. So year four, -5, yeah, a little bit of a recovery, okay? But we're still not going to take anything out of bucket 3. Now, there would be an exception to this. We've had years when the market was down 5 or 6% and we were up 1 or 2% just because we had some really good stock picks. If that is the case, and look at your year end on 2027 compared to year end on 2028, and you're up 2%, but the market's down 7, too bad for the market. I would then take that 2%, go back to where you were at the end of the year, take that little bit of profit and fill up your bonds, because it does give you a little bit more headroom on that bond portfolio. And then year 5, market comes back, bloody, equities recover, resume the normal cascade. And you would be right to say, what happens if there's a 2000 whatever, year 2000, more than 2008, and it's 3 or 4 years? You're probably going to have to make some lifestyle adjustments, because you do not want to go into those equities unless you absolutely have to. And you would have to if you go through all of your bucket 1 money and all of your bucket 2 money, in which case you would just pass money straight from bucket 3 to bucket 1 for 1 year. And then as the market recovers, start refilling bucket 2. All right. When we get to that point, we can have that discussion. Realize this is not portfolio manager. This is financial planning. You guys know that as your portfolio manager and your financial advisor, I do both of those functions for you. They're both very, very important. Okay. I hope this was helpful. It seemed like people wanted to hear more. We're running kind of long tonight, but people wanted to understand better how this buckets in motion works. Let's just quickly go through this again. This is what you want to avoid. Unless you have a fortune-telling gift, you can't decide, or you can't, determine what kind of year you're going to retire in. All right, this 3-bucket framework, those are the 3 buckets. I hope that whoever asked me this question, and I don't recognize your login there, I'm sorry. How do you formulate the composition of each investment bucket? I hope that this did it for you, okay? This is the strategy at CB3. All right, so next month, guys, DS is on deck, and discretionary strategies is its full name. We're going to talk about the active bets, the tactical positions. It has our best track record over the last 7 years, DS. It's the most aggressive of our programs. And how a position graduates from idea to research to sizing, entry, monitoring, or exit. I haven't really done that before, and we're going to do that next month. And you'll take away the framework of why it's systematic and discretionary at the same time. So the discretionary part is not the mechanical trading. We have discretionary over the assets that are in there. It's MAG 7 as the core, not SPY, not QQQ, but MAG 7 as the core. Magnificent 7, those 7 stocks, right? And then we have AI in there, and we also have quantum. Okay. So there it is. That's our show, guys. And again, I apologize for the issues tonight with the audio. I'll have to pay attention next month, make sure that audio is working. If you're new to the program, please subscribe to us on YouTube. Click the little button, and you'll get alerted whenever we go live or when I upload a pre-recorded program. Tweet every single day on Facebook, X, and LinkedIn. If you haven't listened to our podcast, I'm not every single week on these, but most weeks I have a podcast on Monday or Tuesday morning, and you can see that on YouTube, Spotify, Apple, or wherever you listen to your podcast. Next show, Thursday, June 11. Be there or be square, and I will make sure my microphone shows up physically fit for the job for the June show. So our word here of the day: bull markets are born on pessimism, grow on skepticism, mature on optimism, and they die on euphoria. And that's because the highs feel the safest right before they aren't. And that's why we hedge again. We are trying to bring you the highest risk-adjusted returns possible. It will likely never beat, over a 10-year stretch, the absolute return of the S&P 500, because the S&P 500 itself does not care if it drops 58% from its high. If you are 30, you don't care either. If you're 68 or 78, you really care. And that's what we're here to do, to serve our clients. We always close with this slide: for we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. 2 Timothy 1:7. We really appreciate you guys being here for this, and tonight especially. having to suffer through the microphone issues. Again, we'll try to get that worked out for next month. We are heading into Memorial Day weekend next weekend, and I hope you guys have a wonderful time heading into the 4th of July celebration, 250 years. Never been prouder to be an American, never been just more excited to celebrate the wonderful things that this country offers those who want to work and want to produce something and just want to do a great job being American, right? And we're trying to do our part, keeping your portfolios growing as safely as we possibly can. So thanks for watching. We will see you next time. Enjoy the beautiful spring weather wherever you are. I'm Charles Brown, Portfolio Manager at CB3 Financial. We don't just manage your assets, we become one of them. And we'll see you next month.